Uh, Good afternoon, ladies and gentlemen. Welcome to the introduction to corporate finance. This is a module within the BBA 3, Bachelor of Business Administration, Year 3 at SIBA Business School, Semester 1, 2026. So this topic is going to be the first in corporate finance, where we cover some foundational principles of corporate finance. I should say in advance that this is not exhaustive, but it kind of give us an idea, and then we can actually be able to build up on that idea going forward. So in this lesson, we are going to try and explain the objective of corporate finance. What is the objective? Why does corporate finance even exist? We would want to differentiate between profit maximization and value maximization. What are the differences between profit and value? We also want to analyze investment, financing, dividend decisions. How are these decisions made and how do they affect the value of a firm? Then, lastly, we're going to look at the impact of agents, conflicts, and ESG risks on the value of the firm. Right. So now we're going to proceed. In my first slide here, I have to ask, what is financial management? Because financial management can be done at a personal level, and sometimes then they refer to it as personal management, personal finance management. It can also be done at a corporate level, where then they can refer to it as corporate finance management, or it can also be done in different types of spaces, and they can also refer to it as entrepreneurial finance. So, but it is the kind of the same principles that are needed. So, the core principle of the corporate finance, it is that there are three main decisions that it is concerned with. So, the first one is the investment decision, and the second one is the financing decision, and the third one is the dividend decision. So, an investment decision, if I'm to give an example, would be, can I buy a share of Apple, or can I buy a share of Tesla? So, I have to decide, should I buy property, real estate, or should I buy oil, or whether should I buy gold? So you have to decide. So sometimes it depends, you know, how your company operates, and you know the types of investments that you look into. So you might need to evaluate whether these decisions are good or are bad. Those decisions will be on investment products. Then, number two, we've got the financing decision. So you have to decide where you are going to get the money so that you can be able to make that investment. So there are lenders that can give you money. So usually we divide these lenders into two. So we divide them into debt holders, and also equity holders. So these are the ones that will finance your assets of the business. So debt plus equity would be equivalent to the total assets within your business. Equity, it means these are the owners of the company. They bear the high risk within the company. They are the owners of the company. Then this debt, it's debt that you might have gone and taken from the bank. So primarily, there are two sources of finance, which is debt and equity. to give you the assets. So you have to go and look around for capital providers, and you look for those that can provide these two at the cheapest rate, so that you don't pay high interest rates, right? Then we talk about the dividend decision. Dividend decision, there are people that gave you the money to invest. So how are you going to give back this money to these people? So you can decide either you're going to pay them dividends, or you can decide you're going to pay them through increasing their share size or giving them another number of shares within the company, which might be we refer to as stock dividend. So you will have to find a way that will still make your business sustainable. So all these decisions, they are meant to be done in such a way that the business remains sustainable. You don't want to make a poor investment decision. You don't want to finance that investment with a poor finance solution. You also want to pay your shareholders, or you want to pay your interest rates, but also remaining with the business that is sustainable. But out of all this, what is the objective? So the core objective is you want to increase the value. So this is the formula that helps you to do that. So we're going to talk about this formula in depth later on. So the formula says V naught is equals to the summation P is equals to 1 until capital letter T. Then expected cash flows, CFT. So CF, that's cash flows. E represents expected. Then these are cash flows, cash. Then T is the time. Then R is the required rate of return. Required rate of return. That's your R. So when you invest, you are expected to generate cash flows in the future. So, but we discount those cash flows. So that's why we are saying 1 plus R to the T. If the cash flows are in year 1, it means the T becomes 1. If your cash flows are in year 2, it means your T becomes 2. And then you discount all that. Right. So, but that is the core objective. So let's hope as we continue in the lesson and with the module, it's going to become clearer and clearer. So the value of a company is given by V naught today. The value of a company today would be equals to the discount of all the expected cash flows. Right. So let's then move on to another concept. So the big question, why do firms exist? Why do we have companies? Companies are there to generate profit for its shareholders, to increase a market share, or to maximize value. So what are they for? Corporate finance does provide a structured answer for this. And this is the structured answer. I'm sure we saw this in the previous slide. This is still the same thing. What is this? This is value. Value which comes from the discounted future expected cash flows. So it means the corporate finance is saying the right answer is to maximize the value. The right answer is to maximize the value, but not to generate profit. I want you to underline that. The businesses are not there to generate profit at the end, but what they want to do is to maximize value. I'll tell you why. Because profit is something that is kind of abstract, but maximization of value can be something that can be clear and that we can actually talk about. So, why? Because maximization involves cash flow. So, it's actually cash flow, money that is coming in and money that is coming out. But when we talk about profit, there are other numbers that we insert in the income statement that might be accrued revenue. So, that is revenue that we have realized, but we might not have earned it. So that can also create problems, such that when you're now calculating your net profit, it will give you a high number. But that net profit doesn't mean that that is the money that is there in the business, right? Doesn't mean that is money that is there in the business. So it might also be including some of the monies that are not yet earned, but they've just been realized. So that's why profit becomes a bit of a tricky, right? So, who does all this? Who oversees everything that we are talking about? So, the financial manager within a company is responsible for capital budgeting. So, capital budgeting, that's investing. You choose on a range of investment opportunities that are there. You evaluate which one is the best opportunity and then you invest. So, you decide. So, that's an investment decision. Then the other thing is capital structure. How are you going to structure the financing of your company? So we have already said you can structure it in such a way that the other portion, the other portion is given 40% of the capital, the other portion is given 60%. So in total, it will be 100. So I can actually be able to see if this is debt and this is equity, then I can be able to see that the proportion of debt is 40 over 100. The proportion of equity is 60 over 100. Right. So you can be able to see the capital structure. Later on, we're going to ask ourselves, does this kind of a capital structure has any kind of influence on the value of a firm? Right. Then the other part, which is the dividend distribution. So you are distributing back your capital. So all these decisions that you are making, they've got an impact on the cash flow. They've got an impact on the risk. You go back to our formula. Go back to our formula here. You see, all these decisions, whether you are going to invest, financing, they impact the cash flows and they also impact this R. So what we are learning is that the rate, the required rate of return, which is the R, and the cash flows are a very important driver in terms of the value of a company. Later on, we are also going to talk about how do you find that R? How do you find that R? And also, how do you calculate a cash flow? So you can calculate a cash flow. You can get different cash flows. You can use your cash flow statements, and then you can calculate so that you can have your free cash flow to the firm or free cash flow to equity. We will talk about that later on. So there are different types of cash flows. But at this present moment, just know that the R and the CF, they are important drivers of this value that we are looking for. Right. So these have been the traditional objectives of a firm. They want to maximize their profit. They want to make sure that their return is maximized. So, what is the modern objective now? We're talking about wealth maximization, which is the V, which is the value of a company. Why did I say that profit is not very important when we are talking about a business? Because it might not be a true representative of what is happening in the business. But it is important to see if a business is profitable. But also sometimes you need to be very careful when you look at that number, because it is not an end number, but rather a realized number. Why? Because profit ignores timing, profit ignores risk, profit ignores cash flows. Because if I'm talking about profit, profit is just uh, revenue, revenue minus cost. So if your revenue was 100 and your cost was 70, then it means your profit is 30 for that year. So 30 for that year. If you go to year 2, you get 30 or you get 45. Year 3, you get 30 or you get 45. But it's not like that formula that is kind of complex, where you talk about cash flows and there's also an R. For example, if in 3 years, here the question says 100 rand today is worth more than 100 rand in 3 years. So that would be true. Because in 3 years, that 100 rand would have been eaten by inflation. So it is worth more than. But that 100 rand in 3 years, how much is it today? So you can say 100 divided, excuse me, you can say 100 divided by 1.10 to the power of 3. So this is what we refer to as discounting. This is what we refer to as discounting. What value would you get when you discount there? So let's try and discount that. I'm just going to come back here. Let's try and discount that. So I'm using my calculator here. So I'm going to say, right at the bottom there, it's 1.1. And then I say to the power of 3. I'm getting 133. So it means it will be 100 over 1, 3, 3, 1. That's it. That's what I'm getting. So if what would be my final answer, then my final answer would be 100 divided by 1.331. Right, 75. So my answer is 75.13. Just going to write it here, 75.13. What does this mean? It means today, if I invest 75 rand and 13 cents today, for 3 years, earning a 10% annual interest rate, I would get 100. So in other words, that 100 today, it's worth 75, 113. That's what it's worth. This 100 rand, after 3 years, it will be 75 if you do not invest it. So in other words, that 100 today is worth more than the 100 in 3 years. When we get to 3 years, it won't be 100. It will be 75 and 13 cents. Why? Because the value has decreased due to inflation, using this kind of a scenario here. So you need to be able to move forward, calculate the future value, or calculate the discounted values. Right. So I've got an example here. So I've got 2 projects. So project A is guaranteed 100,000, but project B, there's a 50% chance that I'll get 200 and a 50% chance that I'll get a 0. So project B is expected. It's what we expect. But when we are calculating at what we expect, we try and look at different scenarios. So scenario one is you might be successful. Scenario two, unsuccessful. So that's why it's a 50-50 in this case. So 200,000. So the expected cash flow in this case would be 100,000. But here in project A, you are guaranteed 100,000. So the question might be, which project would you choose? Which project would you choose? In my case, I know if I go with project B, there's a likelihood, but there's also another likelihood that I might not get anything. So I'd rather not go with project B, but I would rather go with project A because I'm guaranteed no matter what, there is no risk there. You see? So when we are talking about profit, it does not incorporate risk. But when we are talking about value, so value becomes almost like something that is close to the truth because it incorporates different things, yet profit does not incorporate different things. So we have seen that value does incorporate timing, very important. We are seeing now again that value does incorporate risk. So when you come here, when you are calculating for project B, you are going to say the present value, PV means present value, is equal to the expected cash flow all over 1 plus R. You see? 1 plus R. So the R is high, goes higher if the projects are of a higher risk. And if the R is higher, the number here that is at the bottom becomes higher. It means this whole number at the bottom is higher. So if you divide the top number with a very big number here, it means this number here is going to become small. So that's why they are saying a higher risk, which is a higher R, will lower the present value. So a higher risk, it means that company will be cheaper to buy because of the higher risk. The value of that company would be cheaper. You see? So we are learning that profit ignores risk, but valuation does not. So valuation becomes more like closer and closer to what we want rather than profit. Right. So here's another example. So we have got revenue of 500,000 and there are also expenses of 400,000. The profit is 100,000. Cash received from customers, 0. So this is the information that we've been given. So if I want to calculate profit, it will be easier. Revenue minus all the expenses. So it's this number here, subtract this number. That's why we've got 100,000. So that's why this one here is 100,000. But what are the cash flows? We don't know. The cash flows are 0 because profit is not equal to cash flows. So dividends and value from the cash, not earnings. So value is directly proportional to cash flows. Value is directly proportional to cash flows because we can see it from our equation here that this value here will be direct proportion, but inversely proportional to risk, inversely proportional to risk. Right. Now, we've spoken about timing is very important. We've spoken about risk is very important. We have spoken about cash flow, very important. But how do you calculate the cash flow? So this is your formula to calculate the cash flow. So specifically, this type of a cash flow is a free cash flow to the firm. So you've got your EBIT, 1 minus T. You can get all this from the income statement. Depreciation, you can also get it from the income statement. And then you've got Apex, how much you're spending in terms of your investments. Then you also have got the net working capital that you can calculate, the change in net working capital. So this is how you calculate your free cash flow. A time in later on is going to come where we're going to actually apply this formula. But for now, you can take it as it is. Free cash flow is equals to EBIT 1 minus T plus depreciation minus capex minus the change in net working capital. So only cash can pay dividends. So we need cash. We don't want profit. Only cash can repay debt, and only cash can increase the firm value. If they see, the investors see that your firm is generating cash, then they are willing to invest because they know that even if you are not making profits, but later on, it's more likely that the firm will end up making profits. In terms of liquidity risk, there is no liquidity risk because there is activity within the firm. Right. So here we are talking about maximization of a value, and we have got our formula now put nicely. Max value V naught, which is maximization of value, is equals to the summation T equals to 1 to T expected free cash flow divided by 1 plus R to the power T. These three elements determine what we want. So we are seeing that cash flow, the R, and also the T. These three components will determine the value. So they are important drivers of value. Right. I don't know if that's clear. So, but how do we get the R? Because I think we saw the free cash flow. We kind of saw this is it here, the free cash flow. The T will be given. What about the R? So this is how you determine the R. The discount rate reflects the risk. The discount rate reflects the risk, which is equals to expected risk is equivalent to RF, very important, and plus beta in brackets, you've got RM and RF. So for risk to be high, it means this R is high here, this one. But we know from our formula, which was the summation, and then we've got CF, then we've got 1 plus R. When the R becomes high, the value goes down. We know that. Right. So I'm going to try and unpack some of the points here. So what is this RF? RF is the risk-free rate, risk-free rate, RF. So the risk-free rate can be a rate that when you lend your money to the government, they give you that rate. Let's say I'm investing in a 10-year bond and they tell me that it's 6%. So I'll take that risk rate or that rate as a 6%. But if I'm going to invest in a company and I buy a bond in a company, so it means the risk might actually be 8%. So in other words, there's a premium of 2. But when we talk about a risk-free rate, we are making an assumption that the government will never default. So I make that investment. So that's a risk-free rate. Then the RM is what I'm getting on the market, what I'm getting in the market. For instance, I said for that company, I'm getting 8%. So if I'm going to put 6% that I'm saying here, and then here I'm going to put 8%, and then here I'm going to put 2% again. So I'm going to put 6% here because we said it's 6. So 8 minus 6, that's a 2 plus, do I need that? There's a beta there, plus 6. So it's 6, this part, and then I've got my beta. 8 minus 6, we saw that is 2. And then if you've got a beta, the risk of a specific company relative to the stock market, that is the beta. So you should know that the risk of a market is one. So any company that is going to risk greater than one, it means it's more riskier than the market itself, right? If a company has got less than one, it means the market is less risk. Actually, the market is more risk compared to the company, right? So you can then substitute and get your R. So we're going to do this when we get to CAPM, the capital asset pricing model, which is unit 5. But that's how you determine R. So for now, if a question comes before we get to CAPM, it means you'll be given the R. So your job will now just be to substitute that R. And then the CF, because now you've done your financial statements. And then later on, we're going to explain how you can use those financial statements to determine your CF. But for now, if you are given the number, question comes and you are given the number, you just insert it for now. Right. So these are some of the examples of capital budgeting, investment decision. So here you've got NPV. We're given an example that you invest 500,000, then you receive 600 in next year. And what is the value or the net present value? So this is the 500, which is your cost. But what is this 600,000 today divided by 1.110? What do you get? So we can try and do it here. 600 divided by 110. I got my 600 now, divide by 110. I'm getting 545. So I'm getting 545.454. Subtract 500,000. So if you subtract that, it means you're going to remain with 45,454. Because this is the cash flow that you received. This one. Right. Hopefully it's clear. So the NPV, it does adjust for time, risk, and cash flows. Very important. Okay. But profit does none of this. So this statement here is very important. So the other thing that is important is the financing decision. Financing decision. So when we talk about the financing decision, you talk about the WACC. WACC refers to the weighted average cost of capital. Remember earlier on, I said you've got your structure of a company. So let me just draw my structure nicely here. So I've got a structure, but this structure is divided into two. So this structure is hundreds. That's how they finance themselves, but they finance themselves with 80% equity and 20% debt. So I can put my labels here to say this is debt and this is equity. Right. But debt is giving me, their required rate of return is 10%. Then equity would be more risk. Maybe their required rate of return is 12%. So when you're calculating your WACC, you just have to substitute all these numbers. What is the weight for equity? It's 80 over 100. I've substituted this part here. But what is the required rate of return there? It's 12%. Then you say plus. DV, what is the ratio? is 20 over 80. And then the cost of your debt is 10%, which is 0.1. There's supposed to be multiplication sign here. Then 1 minus t. 1 minus t. You use whatever text that you are given there. And then you are able to calculate the work. And we are saying this structure here does have an impact on the value of a firm. Because when you get the work, that's the work that you can use where there's an error there. You can use that work because that is the required rate of return. So when you are using that work, it means it comes from these proportions. So definitely it does have an impact. I'm going to come here again so that I can show you what I mean here. This is what I mean here. You see? Because I need to calculate this. So this R here, we know that this R comes from equals what? Equals RF plus beta RM minus RF. We know where that R comes from. Is it? Also, you can get that R through work. Through work. Is it? And then you know your work. So the weighting of debt over multiplied by RD 1 minus T. Then plus work B, not work, but weight. And then RE, which is the required rate of equity. So this was giving me equity, But now the work gives me a combination of the required rate of return when there is debt and equity. Yeah. So whenever you put a work there, you see, whenever you put a work, then it means you should be having free cash flows to the firm. So in your terms, the R becomes a work. Right. So that's why the work is very important determining the value of a firm. Okay. Let's just go further. So why the capital structure? So we've seen the capital structure is very, very important because of that work, and that work can be used to replace R. You know, so there are many things that it carries. So the R carries a lot of things. The work carries a lot of things. Combined, the debt and the equity gives you the work. Why capital structure matters? Capital structure matters because we've seen that it does have an impact on the value of a company. Too much debt will raise the risk of a company. And we know that if the risk of a company is raised, it's going to compromise the value of the company because more investors can see that this company is risk. So they'll perceive it in another way. The required rate of return, which is your value, the required rate of return, which is the R, it does go up. Does go up. Yeah, this one does go up, which is the R. Then the value of a firm is equals to value plus tax shield minus your stress cost. So that will be your value of the firm here. Okay. Does dividend policy affect a value of a firm? So we've got this formula here. We're going to derive it later on. This formula is called the Gordon Growth Model, and it comes in this form. D1, which is the next dividend, R minus G. And this is the value. So it's the same. The value of a firm, yes, those summations. So if I continue adding those summations, we can create a geometric series which we can then make to converge. And then when it converges, You take the sectorization, all the similar components that are within that long thing that you have here in terms of addition, and then it will give you D1 over R minus G. But we are going to do this when we get to the golden growth model, but it's important. So when you go back to your formula, you can now know that dividends do have an impact. WACC does have an impact as well. You see, issues to do with timing, risk, all those things, they've got to do with impact. And people read, when you are looking at your dividend policy, people read what's happening. Does it say there's going to be growth? Does it show that the company is in need of financial needs? What does it signal to the market? Sometimes it signals to the market that this company has got very good cash flows when you are paying your debts. Or if you're not able to pay them, then it means this company is facing a risk of liquidation. So you just need to be aware of that. So these are business structures. I'm not going to touch about this, but I can touch about this. The agent's theory. Ownership and control may be separated. Managers may not act in the shareholders' best interest. Yeah, that's true. That's true. So a company is made up of shareholders and their managers. So the managers might focus mainly on their interests, which might be to pay themselves high salaries, which might be to travel using company money, at which the investors might, of which the investors might not have approved that, or whatever trip you might be taking does not have anything to do with the company, but you are doing that business, right? So managers may not act in shareholders' best interest. So agents cost, we are talking about monitoring costs, we're talking about bonding cost, and then we're talking about residual cost. Right. So agent cost comes in different forms. So now we've learned that managers can, in fact, concentrate more on their interest more than the interests of a shareholder, and that creates that kind of a situation. So, what happens when we talk about the agents? So, the agents is divided into three. You can talk about monitoring, you can talk about bonding, you can talk about residual loss. So, when we talk about monitoring, these are costs paid by shareholders to watch, control, and assess managers. So, like they can pay an auditing company, they can pay a board, or then they can also pay for performance reviews to say, what is it that has been happening in this company? So, these are agents' costs. So, the shareholders will have to bear them because they want their company to be audited so that managers are doing the right thing. So, we refer to that as monitoring cost. Then board cost, these are costs that are incurred by managers to assure shareholders that they will act properly. So managers will have to incur these costs because they want to assure holders that they are acting properly. So what will they do? They would engage into contractual commitments with other companies that are supplying them. So if shareholders see that, oh, these guys have got a long-term contract with a certain company, then it means it's a going concern company. You can also sign guarantees, and abiding by restrictions within contracts. So you are, as a manager, you are making sure that your work is up to scratch. Why? Because you want to please the shareholders. And that might actually mean that you have to hire other people to help you do that task within the company because you want to please those. Then the last one, we're talking about the residual loss. So the residual loss is the value lost even after monitoring and bonding are in place. So how does this rise? It rises because managers' decisions may still not fully maximize shareholders' wealth. So in other words, agents' problems are reduced but not eliminated. So what are we saying? We are saying managers' decisions may still not fully maximize shareholders' wealth. So whatever decision that they're doing might still not uh, fully reflect or maximize shareholders' wealth. So they did not get to that point. Why? It might be because of some inefficiencies within the company or some that are minimal that we are not able to capture, but the maximization of value was not reached. Right. So let's go on to the next slide and see what we have. So here, I just wanted you to know that this part here, when we are talking about financial markets, this is where the managers raise their money or they trade or they go there to find new investments. They go there to try and borrow money. So the firms raise this capital through financial markets and financial institutions. So we know that the households will have the money going to the markets and then the money goes to the firms. How? The markets are where we buy things. So when we buy things, the firm will get what? Will get the money. But the households are the ones that have the money and then they go and buy to the firms as well. But how do they get the money? They will also have been paid their labor by firms as well. So it just becomes more like a secular thing where the firm is here, then here you've got your household, then here you've got the market, then on the side here you've got factor market where you're going to end. So it's going to be like a scale like this going down, you know. So firm, factor labor, that's where you get the income from because you've worked, produced, and then the household is money now, and then it goes back again and sells those things. Right. So this is where everything happens. This is where you go and meet your investors. This is where you find money. You go and borrow money there. Right. Even if I want to invest something, I also go to the financial market. Right. I don't want to bore you with all that. So we've spoken about the agents problem and we spoke about the agents cost and we say these agents cost they come in different forms, monitoring costs and also bonding costs. And then the last one was the residual loss. So, for instance, if managers become very ethical, like they don't use company money for things that are not the company's business. They don't use company money. They really abide by their governance structure. They really listen to their governing bodies within that company. So it means they are kind of ethical. They are honest. You can trust them. But if they're not ethical, then many things might go wrong. They find ways to be corrupt. They make wrong procurements within the company. So you need a manager that is ethical. So as investors or as researchers, we look at the credibility of these people that are running these organizations because they have to be very ethical. Because if they are not ethical, there are risks that come with that. So modern corporate finance recognizes governance quality, environmental risk, and social responsibility. So we are saying modern corporate finance. So it means long back they used to kind of ignore this. The shareholders, they just want profit regardless of poor controls within the company, regardless of them uh, polluting the environment, regardless of the social aspects or the social components, social cohesion that is required to make sure that the society functions properly in terms of equity and in terms of um, various things that need to be included when we are looking at equality. So poor governance increases risk. So when, as an investor, I'm looking at your company and I can see that your governance is not strong, it means I want a higher required rate of return. And we know that when the R goes up, the V goes down. So all those things. So this is kind of very important concepts. And sometimes we need some data. Exactly when we talk about environment, what are we talking about? Climate. You see, we are talking about how climate is influencing all these other risks and influencing all these other financial decisions. So, how do we capture that? It's an environmental risk. So, if your company only does employ people from a certain region and ignores some people from a certain region, there's going to be discontentment and you are going to deal with that discontentment. So, kind of social responsibility and governance qualities as well. So, that is very, very important. I want you guys to read what do they refer to it as Kim 4, the Kim 4 report, right? So that you can understand much, much better. I've attached it in the LMS so you can read about it. I want more stories. Actually, you should dwell more on this. Take some time to really read how these things impact um, various companies. Take a company, read about it, understand what is their governance quality, environmental risks that they're facing, and social responsibility. Each and every company does have risks, and these risks at different levels, and they're exposed to them differently as well. Right. So now, in my last slide, I just wanted you guys to remember some of the important things that we've learned. So, definitions about value, definitions about the R, some definitions were in formula form, definitions about the cash flow, and some of the differences between profit and value. And we said value is very important. Decision makers, uh, what is the objective when you're making a certain decision? Then we also spoke about the organizational form, business, but this one I skipped it. You have different types of business. So there's sole proprietorship, there's private company, or it can be a public company. And then there's what? Agents, conflict that we discussed about. And then market environment, cost of capital, where we spoke about the work. And we say this work is needed. So you can have your CF over 1 plus, instead of R, you can say work. But you use work if this is a free cash flow to the firm. That's when you use work. Right. Right. So everything that we are trying to do, we are trying to find the risk adjusted present value of all cash flows. So of all cash flows within the company. Right, ladies and gentlemen, I just want to say this is the end of our first lesson. Please tune into it, study more, use other textbooks. So this was not exhaustive by all means, but it kind of gives us a starting point. Thank you very much.